congratulate you for this.
Is this the same paper I've read? Yeah.
It was a tremendous asset for the discussion bringing this up, no? Like in Brazil, for example, when we start talking to them, the paper was like I'm already on, but the paper.
What do you want me to say?
Good afternoon, everyone, or good morning. It's still before 12. Welcome to the Barbados Pavilion, and welcome to this session on supercharging the energy transition, where we're launching our report called Supercharging the Energy Transition, which is about how we generate the $1 trillion of flows per year into developing countries for the green transition. We know that the vast amount, one of the reasons why we are so concerned about greenhouse gases, and it's such a problem, is that when they go up into the atmosphere, they stay there. They stay there in some cases for 1,000 years. It means up in the atmosphere we have a map of the history of the Industrial Revolution and much of the past 200 and 300 years. And we know that the developed economies contributed some 79 to 80% of that stock of greenhouse gases. Arguably, that's how they got rich, by putting the greenhouse gases up in the atmosphere. But equally, we know that through that process, we've consumed 85% of our carbon budget. We only have 15% left. And the countries that are now contributing greenhouse gases, because the technologies for carbon capture are still, after a long time, in their infancy. So now, if we want to stay below that carbon budget, we've got to reduce the new emissions dramatically. And those new emissions are coming from a very different set of countries. Today, 63% of greenhouse gas emissions are coming from developing countries. And that's going to be rising steeply. The vast amount of the new energy demand is coming from emerging markets. So how do we accelerate the green transformation? It requires a considerable amount of money. Estimated in the independent high-level expert group report, over $2.4 trillion per year for climate change costs in developing countries. As you know, we in Bridgetown break that up between activities that generate revenues, activities that generate savings, activities that have pure costs. And by breaking it down that way, we believe we can get to the 2.4 trillion. An important role is going to be the private sector involved in activities that generates revenues. A lot of that is mitigation. Solar farms, wind turbines, hydroelectric power, geothermal, that generates money. In the developed world, one of the things the Global Stocktake tells us is that in the developed world, there's a lot of investment in that transformation and mitigation. And much of it funded by the private sector. Over 80% of mitigation efforts in the developed world is being funded by the private sector. In the developing world, though, that's around 14%. So in the countries that are going to have the biggest increase in energy, where we need to have the fastest, biggest green transformation, private sector flows are not going. And those governments don't have the balance sheet to make up the difference. So how do we unblock the flow of capital? And that's what this paper is all about. And it argues that the principal obstacle is the very large difference in the cost of capital. So building a solar farm in Germany, in Europe, cost of capital, the weighted average cost of capital in recent years has been as low as 4%. In South Africa, that cost of capital can be above 14%. Projects, technologies, contracts that work in Germany are not viable in South Africa at that cost of capital. And the same thing is in Brazil, in Indonesia, in Mexico. So how do we lower the cost of capital? When you say lower the cost of capital, especially to development finance people, they think that's how I de-risk the project. How do I de-risk the sector? Because they are project managers in large part. And so there's a fair bit of effort on de-risking projects, de-risking sectors. That effort could be increased, but there's a fair bit of attention on that. These institutions are not macro in their thinking. And yet if you look at the macro, you find a very odd conundrum, which is, take the case of South Africa or Indonesia or Brazil or Mexico. The large amount of the increase of that different cost of capital can be attributed to the cost of capital of lending to the government of that country, where there's no project risk or sector risk issues. And we're not paying attention to that macro risk that is often embedded in currency fluctuations. Now we're talking about a set of countries that actually have markets. We're not talking about all developing countries. We're talking about the Brazils and the South Africas and the Indonesias and the Mexicos. They've got markets. You can hedge these risks in markets. And the cost of hedging the macro risk is very large. It is a key blockage for the flow of capital. Let me end up by saying a couple other things. When I say to people that the project risks are small, they look at me as if I'm smoking something from the Caribbean. They say, but you're in a developing country. And what they don't appreciate, and I spent some of my recent years as being the chief negotiator for my tiny island with FDI investors coming to the Caribbean, coming to Barbados. We offer the private sector almost everything. We give them guarantees that their favorable tax rate will not change for 25 years. For the next 5 elections, we're saying whoever is elected in 5 different parliaments, it's not going to impact your tax rate. We're going to give you a pricing formula that we will not change. And if we change it and you lose money, you can take us to court in New York or London. No developed country does that. And that is why the project risk is actually as low as it is, and the macro risk as high as it is. This paper is about how you reduce that macro risk. A large amount of that macro risk is embedded in the cost of hedging foreign exchange. Now, some people say, well, maybe they shouldn't borrow money abroad. And let me make an important point, which is that deepening domestic capital markets is very important. But it cannot be the solution if we're asking countries to have a faster and bigger transformation than ever done in the history of the world, It means investment will exceed savings. And when investment exceeds savings, you're borrowing capital. So foreign exchange matters. Now, when you hedge the South African rand, you're paying about 12% per year for the hedge. The South African rand falls 6% per year. You're overpaying by 6%. That overpayment is a risk premium. It's a premium, an additional return the market says I need for taking on this risk, even beyond the actual risk. Because there's uncertainty, because the risk may change. But that excess risk premium is so big that if we were to reduce it, we'd actually get the return, these projects' returns would be viable, and we could unblock the flow of capital. A project that was yielding 14% when hedged back into US dollars, now yielding 2%. If we can reduce the cost of capital, the cost of hedging, from 12 to 6, that return is that currency return, that dollar return, goes from 2% to 8%. It's now in the region of what institutional investors are looking for. And that's the way to unblock the flow. So this paper is about saying, if we're going to supercharge the flow, if we're going to have the green transformation, if we're going to save the planet, we need the green transformation in emerging markets. To have the green transformation in emerging markets, we need to unblock private capital flows from overseas. And hedging costs are one of the big problems. We need to reduce it. So I have a great set of people here to come and talk to you about that. On my right, I have Anderson Caputo Silva, who is at the IDB, and they have recently been working with Brazil on a very interesting project on trying to address this problem. I have Mattia Romani, who's been working very closely with the COP presidency on the finance declaration and the finance efforts. And I think that the finance declaration is one of the most significant parts of this COP. We're seeing a real clear emergence of a financial system, a new climate financial system. And a key component of that new climate financial system is private sector flows and how we de-risk the private sector flows and how we deal with FX risk. And on my left, Vikram Wedge, who works at CPI, a very important think tank on climate. Much of our thinking on climate, we think is our own thinking, but actually comes from their numbers and their thinking beforehand and their reports, but they're just very generous with their ideas. So thank you very much, the three of you, for being here. Maybe if we could kick off and go from this side down, Anderson, to talk to us a little bit about your thoughts on this issue and what you're thinking of doing.
Okay. I forget that I have it here. Good morning, everyone. It's a pleasure to be here. Like Avinash, first of all, I would like to thank you for this paper, because this paper really elevated, made it very evident the debate, and you put in a very simple way, in very eloquent way, the relevance of the macro risk, and then getting macro risk really as a main factor, resonates really well with what is the new agenda for the MDBs too, right? Because you mentioned well that the micro risks had been the topic and etc., but in a context of mobilization of capital in much larger scale. And the second part is not only mobilizing capital, but mobilizing capital for impact. This brings and it's one of your arguments. It's not for everything, how can we channel that to what the countries need the most and the world needs the most, And then it is in this context that the thoughts is that there is a much more holistic approach of view of how to address these things and the tasks that MDBs need to be concerned about. Right now, there is much more discussion on how we can help reduce risks and then attract the capital. And then the paper shows well that the risks are not on the micro risks, but how can we reduce macro risks, be it like sovereign risks, and then what the paper does really well, which was a kind of a forgotten side that is so relevant, is the FX risk, how you could bring solutions. You put very well that in this agenda, we need to break into what can be like a longer-term solutions, like let's work on building local currency markets. Then you require like a building savings in the domestic market. You require having like good money markets so that you can also hedge. So that is an agenda that needs to be there. But the urgency that we have cannot allow that, and that brings us to pragmatic solutions that we need to have. No? You pose one, and then I think that a key message behind is that for these pragmatic solutions to be there needs to be also a more proactive role of governments, like of multilaterals, and of catalytic capital. Like, because I think that in many of these, some catalytic capital and blended will be needed. No? And I think that your point, I can tell, maybe, I don't know if there will be another round, I can tell more about the discussions we're having in Brazil a bit, no? And the toolkit. But what I wanted to say is that we need to see that in a perspective of what are the different tools that could attract the longer-term investor to these countries. A lot of this in the more developed countries, developing, like the larger developing countries, like the market is there. And then what are the other types of instruments that could be used? Now, I was going to tell particularly about like a liquidity facilities, FX, etc. But that can be in the next round. Okay.
Mattia.
Well, thank you very much. So let me just start by first saying a big thank you to Avi, because Avinash has not only been behind the Bridgetown initiative, but has been absolutely instrumental to push the frontier of the work of the COP28 team, UAE, to develop finance deliverables for this COP that were meaningful. So, Avi, you've done great work in that sense, and I really commend your efforts. The second thing I need to say is that I hate being on the panel with no women, but it's entirely my fault and Vikram's fault, because we replaced Catherine and Barbara, and they both are much smarter than I am, certainly. I can't speak for Vikram, so I apologize for that. It's not Avi's fault. He had built a perfectly balanced panel, so I apologize for that. But hey, you're stuck with us today. Let me get on the content for a moment, and I want to say three things. One, this is a really meaningful piece of work, and of course, it's the starting point. We need to do much more work on how this facility in particular could work. I think the analysis of the problem is part to none. It's amazing. We need to figure out how this facility works, and I know we're talking to the IMF, we're talking to the World Bank, we're talking to others on how this could come together, and let's perhaps focus the conversation about this. So the second thing I want to touch upon is that I think the paper says it very clearly. I just want to make this sort of crystal clear. No hedging facility will ever be a replacement for macro stability. So as you work on hedging, you also have to work to create macro institutions that work better and better, predictable, focused on central bank focused on inflation, that work independently and so on. So this needs to go in parallel. Nobody says, and that's beautiful because it means we don't need hedging forever. We need hedging until those risks, which are real risks, come down. But hedging is essential to accelerate the energy transition, given we don't have 20, 30 years. We have at best 5 to 10 years to rebuild our energy system in emerging developing countries. So let me focus a second, and there'll be another round, on the design of the instrument. I had dinner yesterday. You know, we do all these dinners. I was lucky enough, I was sitting next to the CFO of Masdar. Masdar has invested 50 billion in renewables, some of it, not all of it, some of it in emerging developing countries. So it's great. I asked them, okay, Niall, he's Irish, he's very straightforward. Tell me about currency risk. How many times have you not been paid because of a currency event? And he told me, never. We have never not been paid because of a currency event. And I said, okay, you have to explain this to me, because tomorrow I have to tell an audience why this is. And he said, look, this is our renewable project. First of all, he said, look, we work in a few emerging markets, not the high-risk ones. And all that matters to us is investment, delivery, and getting the money out. That's all that matters. You get the money in, committed, you do the investment, and you find a way of getting the money out. The risky period is when you put the money down, the solar panels, the windmills, that cost hundreds of millions of dollars, and then you have to wait for 2 or 3 years before the revenues come in. There you have a foreign exchange exposure. Why? You paid in dollars, and the value of those assets is like any asset, is the net present values, the streams of income that you will derive from those assets, which are in local currency. So if you have a devaluation at that point, suddenly, no matter how many millions of dollars you put, the value of the asset will go down, and that's really risky. After that moment, when you start producing and selling, of course you receive revenue in local currency, but it's a cycle. You receive them every month. So every month, you receive your revenue in currency, you immediately go to central bank, and if you can, you turn into our currency and take it out. So the process of taking it out is the one that is at risk, because if there's a currency devaluation and the bank cannot turn your local currency into hard currency, you have a problem. But you have the problem on 1 month. You have a problem on a quarter of revenues. You don't have a problem on the whole lot. So actually the risk at the moment of operation is not significant. They were lucky in the life of Masdar. They never had an issue with those first few years. In fact, if you're interested, the only times they weren't getting paid was because of COVID. So they didn't get paid for a bit in Jordan, in Serbia because of COVID, and because of the fact that during COVID in many countries agreed to suspend payments for utilities, so the utilities did not have the money. But they really never faced the currency issue. So the point I'm trying to make here is that I think sometimes we overestimate, and it's not just the paper, the investors overestimate the exposure to exchange rate risk. It's sometimes smaller, and that's why I'm going to the design of this facility. I think it'd be very important for this facility to be designed hand in hand with the developers of renewable energy projects, not with everybody that does all sorts of projects in developing emerging countries. Let's specifically, as you rightly suggest in the paper, focus this institution on supporting projects in renewable energy in developing emerging countries, because the risk profile is quite specific. Let me stop here. I have some more ideas for the facility, but a bit later.
I think you raised a lot of really interesting points. And I think just before I hand over to Vikram, one of the problems is that many institutional investors, and one of the things we're saying is that were they not to spend all this money on hedging, they would actually be okay if they have a portfolio, if they have long time, on average. And those are quite big ifs. and institutional investors will say, you know, especially in today's world, they're very focused on and the consultants that drive that business force them to say, what are you a specialist in? And they'll say, well, if you're not a specialist in foreign exchange, don't take that risk. So a lot of people are hedging a risk and paying for a hedge that's more expensive than something they may be prepared, they may be well positioned to carry if they're long-term and there's a portfolio, but they end up paying for this hedge, and those payments are so expensive that it can deter them from making the investment in the first place. Vikram, what are your thoughts on this topic?
I was just harking back, listening to this conversation as a young, and this was clearly many, many, many years ago, as a young investment officer at IFC. So prior to CPI, I was with IFC for about 25 years. And as part of that training and exposure and lessons of learning, and I purposely say this was about 25 years ago, was one of the lessons was don't lend in hard currency if your revenues are all local. The MDBs are still lending in hard currency. So that lesson of experience was well integrated by investment officers worrying about
do the swap on their debt with us, right? But can they transfer this mechanism to the market in a way that this will be de-risking and attracting much more private capital, because we know that we are just a drop in the bucket, but if you do that with mobilization. So that's the essence of what we are working with Brazil, is a toolkit of solutions, and then how we can shift the AAA power that we have in our balance sheet to reach the investor in the end.
But can I ask you a follow-up to that? So we're talking about the risks of the individual investor and project, or an individual central bank trying to, if you like, insure itself. Those things are difficult and easier in a portfolio. Easier if you are looking at trying to hedge multiple projects and multiple currencies with multiple, maybe even time periods, or perhaps less so time periods, but multiple currencies, multiple projects. And aren't the multilateral development banks then well positioned to be offering those kinds of products because they have access to multiple currencies and multiple projects?
Avi, that would be a dream, no? Because you have that capacity. We always talk about scalability, and in these ways, there is scalability in a way that you also diversify risks, no? So that would be a dream. But starting, like if we can have like a few countries where we're building these facilities too, no? That could be also a way that if you cannot go for perhaps one would claim a first best solution, if you can start with some key countries and then package that into diversifying ways, that could be a way to go, right? So I fully agree with your argument. And then the thing is, how can we move fast and start implementing these things, no?
So Mattia, you got us down this road talking about macro stability as being ultimately the thing we're trying to manage. What other ways can we do that without necessarily lowering FX hedging costs?
Yeah. Okay, I'll have to share a little secret that probably nobody, Vikram I think knows. I used to work in a hedge fund. I didn't last very long. I worked for 2 years, and I worked on the sustainability. But what this hedge fund did is it made money on currency movement in emerging developing countries. It was an emerging markets hedge fund, and all they did that. They actually exploited exactly what you have in that paper, the difference between the cost of hedging and the realized risk of currency. So how did they do it? The CIO spent his life on a plane going to meet all the central bankers and all the bankers of the country where he was investing. It was boots on the ground. It was actually getting to know the real risks that were going on and really listening to what was going on in that country. That's how he made his money. And the reason why I'm taking this example is that part of the solution, and I'm sorry to give you, to answer a macro question with a micro answer, but everything's micro. We are economists that were raised in the life of, macroeconomics doesn't exist. It's all about micro. And I actually believe that. So what I mean by this is that if we get more projects in developing emerging countries, more developers in emerging developing countries doing the project, understanding the actual risks, that will in itself be a mechanism to reduce that perceived risk and reduce that hedging cost. So that's one thing that we need to do. And Avi knows very well, this is the spirit of Altera, the fund that the UAE has launched at COP28, the 30 billion fund that was announced. That is the spirit, to get a fund that has the ability to have the boots in the ground. I know it doesn't look like it from the GPs that are listed, BlackRock, Brookfield, TPG. There'll be others that understand the ground much better. These investors also, some of them understand the grounds, but the spirit is very much that. And I think that is absolutely fundamental. If we are successful, Avi, and in the next 5, 7, 10 years, we see the tripling of renewables in emerging and developing countries, that means that a number of investors will have their boots on the ground, will have to have developed this that understanding. The second observation I have is that we simply are not doing well enough with data and the technology we have to share the information about risk properly. And I could get on the GEMS data sets of MDBs, but instead I'll use another example, which is we went for a nice dinner, I'm not sure if you were there, with Joe Stiglitz at Marrakesh. And Joe was saying, I come from the United States. I spent the last 20 years, 30 years, the United States made incredible, so created markets that create the most important innovation in the world around AI and machine learning. What are we using it for? To sell you more stuff on Instagram. That's ridiculous. We should be using those technologies, that data mining, the machine learning, to resolve the biggest problems in the world. And I think, by the way, this is one. And at Systemic, which is the firm I'm a partner at, we're working with Google Minds on trying to figure out how we can use AI and how we can use machine learning to make data about risks in emerging developing countries more accessible and more transparent. So that's another practical thing that we can do. And the third, and I'll stop there, I promise, I want to reiterate the point I made earlier. If this new facility you've invented focuses squarely on renewables in emerging developing countries, the problem becomes much more circumscribed. And if we believe the CFO of Masdar, it may be a problem of hedging just for 2 or 3 years. So the argument that we can only find hedges for 10 years for 5 or 6 currencies in the world doesn't hold anymore. If we need to really hedge for 2 or 3 years while this stuff is built, when the risk is really high, then I think we can develop many more currency hedges at a reasonable cost.
Thank you. Yes. Now, I was struck, when you mentioned about the boots on the ground, because it reminded me that Barbados began about 15 years ago with a credit rating of A-. And then over the course of about 10 years, it went from A- to triple B, to double B, B, B-, triple C, double C. And then one day an investor called up, and by that time I was advising the leader of the opposition, not the prime minister. I was advising Mia Motley. And this investor comes along and says, we're a little bit worried about Barbados. And I say, why were you not worried for the previous 10 years? And they said, well, it's only this year that you've sacked your governor of the central bank. That worries us a lot. And they were quite right, actually, because the following year we defaulted. Now, all the years in which the credit rating was going down, they were earning very good interest rates. And they got out, not enough, not fast enough. But they realized observing what's happening on the ground makes a big difference.
That might have been my hedge fund boss that was talking to you.
But it's one of the challenges for emerging markets, because how can you have feet on the ground, especially if you're an institutional investor in all these different things? And that's one of the reasons why you have a risk premium. They don't have feet on the ground, so they charge a higher risk premium. So what other ways can we be limiting the costs related to these macro risks? Forgetting about foreign exchange specifically, what other things, ways in which we can deal with these macro risks?
Is this on? Can you hear me over them? Oh, good. I can barely hear myself. So
I think that the sound is...
Microphone's not on?
Oh, now it's
Now it is, yeah. Okay, thank you. So Matthias said, well, macroeconomics was not my strongest subject in college. And AI I don't understand. He's just combined the two in a way. So we're going to use AI to address all the macroeconomic, analyze it enough to provide solutions. I think we are done. I don't have much else to say there because I don't understand that whole spectrum there. But let me try something on the micro-ish level, right? Some of you know that we have CPI has something called the Global Innovation Lab for Climate Finance. About 8 years ago now, so in one of the early cycles of the lab, there was a proposal which was actually ultimately selected and incubated called the FX hedging facility, a very not so unique, not a very smart name, but the idea was, could you tranche the risk and have different parties take it and price it differently? And I bring it up because it brings back some of the things that you were talking about, what I mentioned earlier, that any credit risk, there's a nominal depreciation that every investor, every project developer understands and can take on. And this could apply to beyond FX, like you said. So that facility basically said, I think it was like 4.5%, 5%. Let's say 5%. If it depreciated up to 5%, yeah, the project developer would take that risk. If it went beyond that, you'd pay a premium into a facility, and it would ultimately cover you for that risk up to a cap, whatever. It ran into a myriad of issues, never took off. And I maybe share that as a slight note of caution in terms of it's a simpler version of what I think what you're suggesting in your paper. One, there was a lack of, and this I don't mean disparagingly, a lack of sophistication in local, and this was in India, this came out of the India lab, lack of sophistication in local markets to be able to take on a tranche derivative structure like that, right? So this goes back to the earlier point that I think you also made. We need to be investing and supporting through capacity building and products, domestic capital markets, right? You need bonds with yield curves. You need long-term products that people can start to work. You need the derivative regulations, so on and so forth. So that applies to all of the risks, right? The other thing that came about, of course, was that in a way it starts to get donor dependent. Is there a commercial basis for that big tranche that is not somebody has to ultimately take on that risk, right? So there were regulatory issues around it. They weren't explicitly listed, but more we think about it, one of the issues that those kind of products face is adoption by investors is challenging because there's no mark-to-market ability. There's whole accounting issues that come up. Maybe they can be addressed, but that's one of the issues, right? So there were these 2 or 3 issues that sort of have thwarted the adoption of that a couple of times that it has been tried, and maybe some combination or variant with your idea can get it going. In terms of some of the other ideas that we have seen in the market, again require sophistication, and some corporates and investors show that, is bypass the whole long-term market by doing rolling hedges, right? You have a 15, 20-year-old loan. This goes to the point that do you need to hedge everything is one question, but do you need to hedge it for the full tenor of the project as well, right? So with some level of sophistication, you can roll it 5 years at a time. And yes, but you'll still need a bit of a safety net and a balance sheet for that tail risk the black swan event that could happen in those 5 years. So we've seen sort of that happen. And some of the MDBs I know, including my alma mater at the IFC, are thinking of working with domestic financial institutions that have overseas desks. Once again, trying to play off the risk, right? Give them the dollars, they deploy it abroad. They now provide local currency hedges. People are working around it. The point is, we haven't fully been able to, I would say, and FX is a very specific risk, but even the other macro stability risks, how are we going to be able to, a lot of this sounds like everything in the kitchen sink, let's try whatever goes. So is there a sustainable, self-sustaining mechanism that can allow for smart hedging of macro risks, particularly FX, that can be delivered in combination? And it's probably going to be a public-private philanthropy type thing beyond my capabilities, but I think we worry about that, right? And parsing those risks into short-term acceptable risks versus long-term, low probability, high payout tail risks seems to be something that the market is not able to separate out. It combines them all, so you end up paying for something that you don't fully need or don't need it to the extent that they are selling it to you, and you just can't split it out. So I think that would be where some of the focus of both innovation and regulation needs to go to, I think. So.
No, I think that's really interesting. And indeed, one of the things we found in the data was that you get interesting, significant risk premiums over long periods of time. But if you had a very simple rule that said, look, I know that the markets have feast and famine. And on average, it's a bit of famine, but there are feast times too. And I don't want to be hedging during the feast times. And I simply hedged when the hedging costs were above the previous 3 years. Then the excess risk premium that you capture was even twice or 3 times greater. So you could do smartly hedging less often with actually better risk-return trade-offs.
The one issue we have to deal with there is what if famine comes before the feast? Right?
Yes.
If you have a lot more famine before you
capital
have
doesn't
made that
flow.
money and you've lost your capital, how do you sort of
Exactly.
deal with
Yeah.
that? That's
Well, you're making the money
Beyond
in the
my-
famine.
Very
You're
good
actually
point.
making the money in the famine. So, because in the famine, the risk premiums are huge. Right? So, you need a discipline to not hedge at certain
Yeah.
times.
Yeah.
And that's actually hard for the markets to do. If you imagine your emerging market hedge fund, and he says for a whole year, "Oh, we're not doing anything in the market this year,"
That's not how
people
they work.
say,
Yeah.
"What do you do with my money?"
Exactly, exactly. Can I come back to one point? Because I know we want to hear from the audience, but I hate to come across as the guy that thinks that AI is going to solve everything so we can all go home.
sorry, I was a little
No,
facetious
that
there.
was a bit facetious. No, it's fine. I just want to explain how this thing works because it's not particularly complicated. Otherwise, I wouldn't get it in 10 seconds. All this is a bit of machine learning AI that is capable of pulling together very, very diverse data sets that exist on emerging market risk at the project base, if they can get access to it, and hence the GEM data set and the various efforts which are being made to share this data. They'll be in all sorts of strange formats. All AI does, it allows you to read those data sets so that you ChatGPT, you ask, I have this project, what is my risk associated with this project in Barbados for 3 years? And it sweeps this data set and it gives you an answer. That's all it does.
With the caution, again, sorry, I seem to be the voice. I don't usually am the voice of caution. But only, and I totally get that. And the machine learning for infrastructure at large has been extremely is likely to be extremely effective, but it's still based on past.
Yeah.
You know, the issue with AI, and thank God for that it cannot predict and compensate for the future, because if it did, it would take over all of us as well.
So we'll look at the bias data that Avish is talking about.
Right.
Avish is talking about.
and then use AI smartly to create smarter predictions. So that's true, yes.
Great. So, do we have any questions or thoughts about this topic of supercharging the green transformation, unblocking the private flows, thinking about foreign exchange markets as the thing we need to address? Yes. So, a question here in the front from Jamie.
I'm coming to you, Jamie, but let me just say beforehand that the paper is available online and it will be up on the screen in just a few minutes. And we want to thank David from the NGO Stamping Out Poverty for making this possible for us.
Hi there. I'm losing my voice, so I've got to speak quietly. But it sounds good, right? What specifically do you need to happen, Avinash, to take this forward in 2024? It's the end of 2023. We have the Italian G7, the Brazilian G20, a few other policy-making moments, some potential leadership. We need sort of clear instructions to get people to ask for the right things in the right places at the right time. We need some research, perhaps, to be further commissioned to stand up and scrutinize some of this. What exactly do you need from us to take this forward?
It's a great question. One of the weird challenges we have with this question, this issue, is actually theological. I'm an economist by training. We teach students of economics that there are no free lunches. that if you see a £5 note on the ground, we say, it cannot be there, I'm not going to pick it up. And so many of the economists trained who end up in the risk management departments of multilateral development banks or international financial institutions say, this cannot exist. And one of the things I've learned in dealing with theological questions is dividing up what is empirical and what is faith. And this is an empirical question. At the back of this paper, and I must thank David Hillman for helping this paper being produced, is a whole set of tables showing the empirical data of how the probability of you losing money changes dramatically if you, for example, only hedge when you're at extreme times. So this is an empirical question, but it is outside the comfort zone of many of the professionals. And I think faced with that, my feeling is, and I'm very open to being persuaded otherwise, that the way to do this is through pilots and people who've been familiar with this idea starting. And one of the reasons why I'm not surprised that Anderson at the IDB and Latin America is thinking about this is that Latin America is full of countries that have had a tremendous amount of foreign exchange volatility, and their central bankers have tried a whole range of different things over the decades in trying to manage that, and have now converged over time to an interesting balance of active action, intervention, and not. But I think it is getting some people to start. The challenge of starting in a small way in one place is also you don't get the portfolio effects. So if you're just 2 or 3 currencies in the same place, so we need to have some pilots and experimentation, and if they're working, we need to quickly collaborate across to create some diversification. And so I think that's what we need to do. I think that's the plan for 2024. It's to have a series of pilots, not 1, 2, 3, 4, 5. And then we come back here, COP. Hopefully we have a review of what's been happening with these pilots. And of course, it will take longer than 12 months, but at least we start something. That's my thinking, but if other people have ideas on other ways of starting, let me know.
No, let me just fully agree that I think that the fastest way to move, even because of coordination issues that take so long, no? Sometimes you have countries that want to move faster, no? and give that demonstration effect. We need to show that it works, even as I was telling before, it's not a first best, but it's a second best solution that works. No? And that's what we are working with Brazil, and then Brazil leading the G20 and having a very robust plan of ecological transformation, etc., is that for that particular type of projects that require intensive capital now and fast, no? What are these different types of layers of solutions that we discussed here, like a tail risk or liquidity facilities, no? So that the investor can bear some risk and share risks with the government too, no? So that the government steps in with some mild levels of volatility, and very high level of volatilities, you have the market to transfer the risk. So there is risk transfer, there is risk retention, and there is risk taking that they can take. So that's the type of rationale that's behind. No?
And I'm very excited that it's Brazil, given the fact of doing the first pilot, given Brazil's role in COP30 and in the G20. Maybe Brazil's experience and thinking as it evolves with this experiment will allow this to play a more central role in the G20. Please.
It's there, right in front here.
Thank you, Avi. Hans Verolm, I work on loads of different projects, including the Climate Finance Accelerator and a successor program, which is the Pathfinder, where we're working with LDCs and lower middle income countries on bringing blended finance. I very much share the findings that you also seem to agree on. Like, investors are a bit lazy and they bundle everything up and they charge a lot of money for nothing. And this is a real hurdle, particularly when the capital market is small. And I want to go a bit deeper there because, you know, Brazil in that sense is like the wrong country for a pilot. I mean, you should still do it, but, you know, we're going to be looking with CAF at Bolivia, right? Slightly smaller. But for the Caribbean, even that's big, right? So what do you think about the kinds of pilots we can do on the islands so that we can sort of not wait 5 to 10 years, as you point out? It's too late. We need those things now.
Brazil is the exact type of country we want. Because what we're trying to do is supercharge the energy transition. And the energy transition needs to take place in a narrow set of emerging markets, which are large. They are big emitters. They're big emitters. They're the ones that need to transition. Private capital is not going there. Private capital is not going there, even though there are markets there. There are hedging markets. There are foreign exchange markets. And so this solution is a solution designed for the big emitters whose economies are mid-size. That almost none of them will be eligible for IDA money. They're middle-income, large emitters who have markets, but the private sector is not financing the green transition. So it's how do we unblock that? The Caribbean is not a big emitter. It doesn't have a lot of mitigation. Our big problem in the Caribbean is adaptation and building resilience. We are moving on mitigation substantially using solar power, and by paying high rates of feed-in tariffs, we're getting that transition. We have a 2030 target for net zero. Barbados has a 2030 target for net zero, and we can achieve that. We're about half the way there. We can achieve that through solar power. But Brazil is the one we want. Brazil, Indonesia, Mexico, South Africa. Big emitters, big markets, no transition. The lady first?
Microphone is here. Yeah.
Hi, perfect. Hi, my name is Alejandra, and I'm actually a journalist at Carbon Post. And in terms of talking about de-risking climate finance, there's been a lot of talk about the potential to get climate finance flowing through Article 6.2 of the Paris Agreement at this summit. So I was just wondering what kinds of risk management techniques or facilities might be important to support Article 6.2 projects for green energy transition, whether in small island states or elsewhere.
I'm happy to take that. It's fine? Okay. But, okay, so 6.2 then, actually the advantage of 6.2 from where I sit is that it doesn't suffer from a lot of the FX type risks that we are talking about because money is flowing one way, right? I mean, so just so I understand your question, when you talk about Article 6.2 and some of the energy transition countries that Avi is highlighting are going to be a destination for a lot of these large programs like the Energy Transition Accelerator and the JETPs, but a country is committing to undertaking a just energy transition, generating carbon credits or transition credits through that, and then effectively transferring them as ITMOs to another sovereign buyer. That's what you're talking about, and the risks associated in that process, right?
Is this still working?
Not working. I don't want to answer the wrong question.
Okay, perfect. Yes, so specifically in certain cases that have started to emerge with Article 6.2, it seems like there are a lot of investors that are trying to harness the contributions by 6.2, well, investor countries, but private investors that are crowding in, and that whose investment is needed to make these projects a reality. And some host countries have argued that it's important to make sure that there are ways that these host countries can de-risk this investment, can essentially make sure that there is more confidence that the carbon credits will ultimately appear, to make sure that there's a good carbon price, to make sure that the money gets flowing for energy transition. So that's what I'm talking about. I don't know if that helps.
So you said it. Then the carbon credits need to get delivered, right? So the main risk there is performance risk. But in order to generate the carbon credits, you need to make the investments today so that they can generate carbon in the future. So we need products that monetize future carbon revenues. We've been talking about that in the context of the Energy Transition Accelerator or the US, or the initiative that the US and a couple other foundations have done. And a lot of these risks that we are talking about then emerge in that context as well. One of the things that is being suggested is that some part of these future carbon revenues be actually utilized in country to capitalize either guarantee funds that could cover either credit risk, non-payment risks, or even specialized instruments that could perhaps cover tail risk of FX. Because now you have a pool of money at the disposal of the host country government that is grant-like, because it's not a loan, it has to be repaid in carbon credits. On the other hand, you have to make sure that those carbon credits get delivered. So
but you know,
I think it's a bit of a catch-22, but I'll defer to
it is,
you.
but actually, I have some sympathy for this comment. So, okay, so there's two issues here. There's the issue related to the carbon markets, and the issue related simply to the project delivery.
Right.
There's some risks associated with project delivery. Okay, we know there are instruments to sort those out.
Right.
They will be needed in this project, probably more than others. They're nature-based projects. They may need some specific instruments. Let's forget about that for a second. But the currency is an interesting one, because basically, if indeed we manage to ever implement Article 6 and get it delivered, then what you'll have is cost in local currency and revenues in hard currency.
It's
so
the
actually
reverse.
it'd be the other way around.
Exactly.
It's actually a great advantage for the country. It'd be literally like having a natural resource, which is what they have. Which
A
is the
mismatch in reverse that's actually beneficial.
Correct. So it does create that.
Very good point.
We've got time for one more question, maybe.
It's a very good point.
Thanks, Asger Ganak, Concito Climate Think Tank. First, briefly on the Mazda argument. I think maybe it confuses project risk and macro risk really, because the project risk declines quickly during the construction phase until operation, but the macro risk related to currency and so on, that actually declines very slowly as you are repaid over the course of the years. So I think this mindset is basically about project risk. It doesn't really answer the issue of macro risk. The other point is, this is very much about perceived risk versus real risk, as Avinash is pointing to. And I think there's an interesting parallel from the guarantee instruments that are now increasingly being deployed. Denmark, Sweden are using sovereign unfunded guarantees, basically backed by their balance sheets, to provide guarantees for development and climate investments in a range of different ways. And they actually calculate a fee based on the expected loss and so on. So there's virtually no concessionality in it. It's actually very similar to what an MDB is doing, right? It's providing finance through a guarantee at an attractive rate, but it's not concessional. And the reason it's attractive is basically because they really put a lot of effort into calculating the real risks of the things they are guaranteeing. So if you can get a setup backed by a publicly financed guarantee, even unfunded, that tries to extract the real risk from the perceived risk, then you'll actually get there. So it's essentially in support of Avinash's argument, even though the specific structure can be varied. That's up for design and discussion, and you can even link it to sovereign balance sheets as well, potentially, not necessarily an MDB balance sheet.
No, it's the easiest question. The answer is yes. You're absolutely right. Guarantees are very, very good when there's a gap between perceived and realized risk. They're very effective and cheap. And we now it's a plug for systemics paper, better guarantees, better finance. It's a piece of work that shows analytically just that. You guys at CPI have done some similar work, and the results are now evident. Norway has just announced a guarantee program, which will be very large. We hope to be able to use some of those instruments for Altera, for the fund here in the UAE. So, yes.
No,
and Germany announced the Green Guarantee Group that's going to explore we did some work on the landscape of guarantees, and they're going to try and see where the gaps are and what new instruments may be needed.
Yeah, no, and the other point, which I think goes very much in line with the arguments that Avi has in the paper, is that the market many times is overshooting, no? And then there is an argument that be it the public sector, be it the government or multilateral organizations, should step in, not necessarily being something that a free lunch. No, you actually going there and providing guarantee, even if it is in a way that is like, especially in a way that's not concessional, and you still can have out of that a positive return, like driving from this overshooting that the market is seeing. No?
So in a sense, guaranteeing against perceived risk, that is actually free lunch.
It's basically, the difference between the risk aversion and the risk neutral. But I think that's a great note for us to end our interesting session. And please join me in thanking our great panelists.
Thank you.